BCE, one of Canada's largest telecom companies, is offering investors a jaw-dropping dividend yield of around 11.6% right now. To put that into perspective, most stocks don't even offer half of that, let alone anything close to double digits. At first glance, this might seem like a dream come true for dividend investors, but here's the thing. When a dividend yield gets that high, it's usually a red flag, not a golden opportunity. So what's going on with BCE? Why isn't everyone rushing to buy a stock offering such a high payout? And the answer lies in two words: dividend risk. Despite the attractive yield, BCE's stock has fallen 37% over the past 12 months. That's a steep decline for a major telecom company. Combine that with weak earnings and bearish technical indicators, and it becomes clear why investors are cautious. The stock's 50-day moving average has been below its 200-day moving average for the past year, which is a bearish trend. And without a reason for investors to have a change of heart on the stock, that means it could go lower in the weeks and months ahead. That also means its already high yield could go even higher, because as the stock price goes down, the yield goes up. But that's assuming the dividend stays intact. That's the big question mark right now. Will BCE cut its dividend this year? Let's break it down, starting with the earnings. BCE's quarterly dividend sits at around $1 per share. But here's the problem. The company's highest quarterly profit per share over the past year was just 59 cents. That's not enough to cover the payout. And while some companies can dip into cash reserves or borrow to maintain their dividend for a while, this strategy isn't sustainable in the long run. And without a noticeable boost in earnings, BCE may have no choice but to cut its dividends sooner rather than later. And it's not just weak earnings that are concerning. BCE is also committing significant resources to growth. Last year, it announced plans to acquire US-based Ziply Fiber in a $5 billion deal. While expanding into the US could be a smart long-term move, it raises questions about BCE's short-term priorities. If management is focused on funding growth initiatives, where's the cash for that hefty dividend going to come from? Plus, even if BCE cuts the dividend, say in half, the yield could still be fairly high at around 6%. That high yield may not seem so scary to dividend investors, it'll still be a good payout, and it would free up some cash for the business. That's why I think BCE will cut its dividend this year. Last year, management already softened up investors by telling them they don't plan to increase the payout in 2025 due to the Ziply acquisition, and that the company was pausing dividend hikes for the time being. And the next move could be to actually cut the dividend, since many investors may already be bracing for that possibility based on the stock's movement. Now, for some investors, the stock might still be worth the risk. That's because BCE looks cheap. It trades at around 12 times its estimated future earnings. The stock looks cheap on paper, but when you factor in weak profitability, it could turn out to be what's known as a value trap, a stock that appears undervalued but continues to struggle, dragging investors down with it. Because if the company's earnings continue to decline, analysts might reduce their estimates for future profits, and what may seem like a cheap stock suddenly becomes an expensive one. Put it all together, and here's the bottom line. BCE's dividend might look tempting, but the risks are piling up. Whether it's weak earnings, the push for US expansion, or the stock's bearish trend, all signs point to a potential dividend cut on the horizon. And when that happens, the stock could fall even further as income investors look elsewhere for a high yield. If you're holding BCE for that massive payout, it may be time to rethink your strategy. The yield is impressive, but when a dividend isn't sustainable, chasing it can end up costing you more than it's worth. On the flip side, if you're okay with the risk, this could make for a good contrarian pick, because if BCE's growth strategy in the US pays off, the returns may be massive for the stock given how beaten down its valuation is right now. But one thing seems clear, and that's that BCE's strategy has clearly changed, and it may be a much riskier and more volatile stock to own going forward.